And we are going to be listening to Carolina Minio-Paluello, Global Head of Product, Solution and Quant at Schroders, and Andrew Howard, Head of Sustainability and Research at Schroders.
Good morning, and thank you for inviting us for these very topical discussions about sustainability and impact. I'm Carolina Minio-Paluello, Global Head of Product, Solution and Quant, and I'm joined by my colleague Andy Howard, our Global Head of Sustainable Investing, who will start by giving us an overview of the challenges and, of course, how we are approaching it. Thank you, Andy.
Thanks, Carolina. I'm going to talk for a minute or two about the backdrop of change that we see in the world and how that's impacting how we think about the future and our role within it. The reality is that social and environmental change are upending many of the things that we've taken for granted within investment management. We're an industry that in many ways has historically defined ourselves through our ability to generate returns. More recently, over the last few decades, risk management has become a bigger part of the equation. And none of that changes, but the reality as well is that the relationship between what we do as investors and the social and environmental challenges that the world faces is becoming increasingly acute. And we have a role to play both in terms of understanding what that impact is and in terms of understanding how those social challenges will impact the investments that we manage. That means moving from a two-dimensional view of the world, focusing on backward-looking measures of risk and return, to also bringing in a third dimension around impact, about understanding how the investments that we're managing are positioned in terms of their contribution to positive or negative, the challenges that the world faces, in order that we have a better, more complete view of the investments that we're managing, and that we can understand throughout every step of our investment process, internally as well as the way that we communicate externally, how companies, how investments, how portfolios are positioned on all three of those dimensions: risk, return, and impact.
Thank you, Andy, for introducing the objective of today, which is how do we actually introduce impact as a third dimension in what we're doing. We've been heavily involved in the last few years, actually for several years, into integrating ESG into our portfolios. And effectively, that means understanding the ESG risks and opportunities. But of course, today, that is not enough. Our investors, our clients are asking us to effectively also bring that dimension in everything we're doing. So in practice, it means shifting all our assets from what we would call ESG integrated into the sustainable category. Now, the way we define sustainable is, of course, very important. By sustainable for us is investing in companies that not only are likely to transition to a sustainable business model, so effectively strong and improving sustainable business practice, but more importantly, it's favoring companies that have a positive impact on society. Now, the question is, how do we measure impact? And that's where Andy will spend a few minutes in a second describing SustainX, which is our measure of externalities to societies. But of course, moving into sustainability is a journey as an asset manager, and this is something that is within our fiduciary duty. We need to understand the risk, the opportunities, and of course, the impact of our investments. But of course, our investors, our clients, also have their journey. And of course, an increasing number of them want to contribute to this by shifting their assets and align it to their preferences, to their goals. And this preference framework today is called the Sustainable Development Goals. There again, Andy will spend a bit of time in a second describing Themex, which is a tool to estimate the contribution of companies to the Sustainable Development Goals. Of course, being able to estimate the contribution or the link to the SDGs is an extremely important way of actually being able to create bespoke solutions for our investors. So as you can tell from our statement, we're talking about impact, we're talking about having impact, and of course the question is, how do we measure it? So let me introduce Impact IQ, which is a framework of all our series of tools to do that. And as you can see in these slides, we effectively are dividing our tools into categories. On the left-hand side, you will see what I would call broad impact, effectively measuring impact more broadly across to society. And that's where you'll see the SustainX tool that I mentioned before is effectively measuring those externalities. But the fact that we can estimate this cost to societies, it also means that actually what we can do is avoiding the negatives. We can avoid the companies that have too much of a cost on societies. But of course, this is much more broader than simply saying we are going to eliminate coal and tobacco because, of course, they're costly and they're risky. The fact that we can actually estimate the cost of society across all the sectors allows us really to impact all the sectors and really removing this more broad cost. Now, here we're talking about the negatives, but of course you are going to say to us, but what about looking for the positive, looking for an alignment to the Sustainable Development Goals? And that's why on the right-hand side, you will see the reference to the Themex that I was mentioning to you before, where that will allow us to measure the contribution to the SDGs. So think about our tools as avoiding the negative and avoiding the very costly companies to society, and then looking at how they are aligned. In addition to SustainX and Themex, the team has developed additional tools to go into more details on some specific risks. You will see that actually for climate change, as you know, being a very important topic today, the team has developed carbon, environment, physical risk to be able to more granularly look at those risks, and also developed the Governance X, which is a tool to estimate the risk of governance. At the same way, when we're thinking about finding the positive, aligning to the SDGs, within always the climate change related, the team has developed the climate alignment tool, which allow us to measure the portfolio alignment to the Paris Agreement. So all of that is what I would call our series of tools for assessing impact and working very closely with our clients to estimate also the impact on their portfolios. With that, I'll pass it on to Andy that will go into more details into those tools.
Thanks, Carolina. So in many ways, that's the easy bit. Defining what we're trying to achieve and how we want to view ourselves is the first bridge to cross. Fundamentally, however, how do we translate that into objective measures that we can use to quantify and measure our performance across all of our different asset classes and all of our different investments? I'm going to talk a little bit about two tools that Carolina has mentioned, SustainX and Themex, in a little bit more detail about how they work, what they do, and how they can be used. So SustainX to start with, this is a measure of externalities. It's about putting a dollar cost to the impacts that companies have, positive or negative, on society. Fundamentally, this is a framework grounded in academic analysis, transparent data, and systematic measurement across around about 9,000 companies, looking at about 400 academic studies to really understand those costs, and applying that through a very rigorous and systematic data framework to really quantify for all of those companies what impact they're having, positive or negative, on society. And if we look at the different metrics that we've looked at, there's around about 40 in total, some positive, some negative. There are some areas where companies in general positively contribute to society and some where they have bigger negative impacts. So you can see on the left-hand side of this page, for example, a series of areas where companies in general are contributing positively. Most companies pay wages that are higher than living wages. And on the other hand, on the right-hand side, you can see some of the areas where companies tend to have more negative impacts, for example, like emissions of carbon, where this is one of the biggest sources of negative impact that companies have on society that they're not currently charged for. So it gives us a way of combining all of these 40-odd different measures into a consistent view of, when you look at it in the aggregate, for a particular company, is this in total operating at a credit or a deficit? Where are the biggest sources of risk? And what overall exposure does this company face as those externalities increasingly turn into financial costs? And if that sounds like a theoretical question, it isn't. Carbon prices, tax regulation, minimum wages, plastics regulation, sugar taxes are all effectively translating or turning externalities that have historically been social costs into financial costs to companies. And that will only increase in the future. As we see more focus on those impacts, as we see more government intervention and more political pressure, companies will have to deal with the reality that those social impacts will become increasingly financial liabilities or financial benefits, and that their license to operate and their ability to continue to succeed will depend in many ways on their ability to demonstrate a positive contribution to society. So that gives us a way of quantifying in dollars the social costs and the social impacts that individual companies create to society. The question then becomes, how does that relate to the financial exposures and the financial liabilities that those companies will face? There are some areas like carbon pricing, which are relatively well established, where we have over 20% of the world's carbon emissions now having some price attached to them, and that price is rising in many parts of the world. And there are some other areas where those costs will take longer to crystallize, where there's less regulation, and then where there's less social focus. And so we have to distinguish between which of those costs are likely to be financial costs in the near future, and which of those costs, whilst potentially important social costs, will take longer to crystallize as financial costs. And so the work here that we've done is really focusing on, first and foremost, bringing an objectivity and a structure to how do we track and monitor and measure the extent to which regulators, civil society, the public, and companies are focusing on different issues, and the likelihood that those issues become crystallized through regulation, through social pressure, as costs to companies in the near future. And that allows us, in turn, to apply different measures to different weights in a way that really relates the overall social cost of an issue and the likelihood that it crystallizes into an overall measure of the financial impact that that particular issue is likely to have, which we can similarly apply to individual companies, bridging that point between the robust, the academically grounded social costs that I mentioned before, with the financial impacts that ultimately drive portfolio performance and portfolio risk. So in the last couple of minutes, I've talked about the likelihood that it crystallizes, the other side of it, an overall measure of the financial impact that that particular issue reallocation of capital, which we can similarly apply to tackle those sustainable development goals, and that we are beginning to see unlocked in many areas. Themex is the tool that we've created to help find those beneficiaries, as well as identifying the companies that will come under more pressure as changes play out. The way it works is, first of all, by examining thousands of different products and services and different end markets and how well they're aligned to each one of those sustainable development themes. It allows us to ensure that we're treating different themes and different product areas in a consistent way across the market. We can then combine that analysis with an assessment of what companies are actually doing and where they generate revenues in order to get an overall view of every company that's devised or applied systematically and consistently across the market. So by combining that top-down view of product areas and their alignment to different sustainability themes, as well as the view of individual companies and where they're exposed, we can get a consistent and scalable view of how different companies are exposed, positively or negatively, to those sustainable development goals. By working with investment teams and the hundreds of years of knowledge that we have across the organization of looking at these companies, understanding many of the same trends, we can then ensure that we're bringing the knowledge that we've built up within the organization into that consistent framework that we're applying across portfolios. And that gives us a way, ultimately, of being able to systematically and consistently assess how is each individual company exposed to different themes, how are therefore our portfolios exposed to different themes, and how do we build portfolios that are designed specifically to tackle individual themes and individual trends over time.
Thank you, Andy, for these detailed descriptions of our tools for estimating impact. For us to be able to incorporate impact as a third dimension, of course, we need to have this estimation of the impact. But as Andy was describing, it's very important, actually I would say it's critical, that this dimension of impact is completely aligned, correlated, or understood alongside the risk and returns. And that's why the involvement of the portfolio managers is critical, so that over time, this dimension that is becoming very important for society is gradually coming in. And hopefully at some point in time, we'll talk about those three dimensions. Today, there is not one single tool that allow us to measure impact across the entire portfolio. And here we're talking about estimating equities, credit, fixed income, and of course, moving to the private assets. Our ambition, our journey is to be able to estimate across our entire assets the impact of our portfolios. And of course, we are here as we are estimating on our portfolios, is of course, we're here also to work more closely with you to do the next part of the journey together. But thank you very much, and we look forward to your questions. Thank you.
Thank you, Carolina Minio-Paluello and Andrew Howard. And we have a question from one of your viewers. Let's go back to London and Schroders, if you're with us. So this is a question from one of the viewers to Schroders. How will your risk management change due to COVID impact?
So in terms of the impact of COVID and how we think about risk management and how we think about what we're doing, I think the way I would look at it is this, is that COVID in many ways has accelerated and really brought to the fore a lot of issues that frankly we've been talking about for a number of years. We've talked a great deal about sustainability and kind of the interaction and the relationship between social and environmental challenges and how we think about managing money and how we approach managing money as a firm. Slides aside, in January, we did an offsite within our team and looked at, before COVID really started to hit the headlines, what do we think the big issues are for this year and for the next few years? When I look back today at what we said then, most of those things have accelerated and been accentuated by COVID. So we were talking about protecting gig economy workers. We were talking about inequalities within society and the impact that would have on policy measures. We were talking about climate change and the need for reallocation of capital at a political level. All of these are things that have been accelerated by COVID. And what COVID has really done, I think, is it's accelerating in many ways, people, policymakers, societies focus on issues that in some ways have been with us for some time, but it's bringing to the fore, these aren't simply academic theoretical questions, these are increasingly things that are very real social and political items that will have an increasing impact on industries and companies, and it's vital that we approach risk management as a result in a different way. That we don't simply think of risk management as being a backward-looking measure of standard deviations. It's about understanding what's happening in the real world and how will that impact the value of the investments that we're managing. And that's really, hopefully, the points that we've been through this morning, hopefully give you an indication of how we're trying to tackle that problem.
And actually, if I could just add one point, which I think is a very critical question, is you should know that even long before we started with COVID, within the risk management and risk oversight of all our investment teams, those forward-looking estimates of cost to society of risk that, of course, will impact companies and sectors were already fully included in our risk dashboard and management discussed. So, as Andy is saying, this is just accelerating the importance, but the framework was already in place for that to become an integral part of our decisions.
This process that you described earlier, how easy, or maybe I should say difficult, has it been to implement at Schroders?
This is of course very, very critical, because one, we are making the statement of understanding the ESG risk and opportunities, and now really trying also to link in the future impact of societies. Of course, this can only happen with the buy-in of the portfolio managers, and there is no way you tell any portfolio managers to do something unless he feels it's part of his fiduciary duty, understanding the risk and the opportunity. So we've actually been working very closely with them in terms of assisting them in their decision-making, the way they can engage with companies, providing better information, proving the materiality of data, and then taking them through a journey. So the challenge is making sure that we do that across all the portfolio managers, across equities and across fixed income, and lead this journey together. And that's why, to your previous question, risk management has been an integral part of this, I would say, this journey.
Well, thank you so much, Carolina Minio-Paluello, Global Head of Product Solution and Quant, and Andrew Howard, Head of Sustainability Research, both at Schroders.